Gold's rise in instability is driven by three interconnected forces that directly challenge the integrity of the modern financial system. Reason 1. The inflation hedge, gold versus the printing press. The most immediate driver of the gold price surge is inflation. Inflation is the decrease in the purchasing power of money, often caused by governments or central banks printing too much currency or expanding the money supply too quickly. Think of it this way. Fiat currency, like the US dollar, the euro, or the yen, can be created infinitely with the push of a button. When governments need to pay debts or fund stimulus packages, they print more. The more units of currency exist, the less each unit is worth. This is the source of inflation. Gold is the opposite. Its supply is scarce and finite. Every ounce of gold ever mined is estimated to be around 244,000 metric tons. And while new gold is found, the rate of discovery, the above-ground supply, is incredibly slow and stable. Therefore, when the dollar loses 5% of its purchasing power in a year due to inflation, the dollar price of a fixed asset like gold must increase to reflect the true preserved value. Gold is not getting more expensive. The dollar is getting cheaper. Gold becomes a stable yardstick in a turbulent sea of expanding paper money. Reason 2. Lack of counterparty risk, the solvency factor. In times of extreme crisis, like a banking collapse or a sovereign debt crisis, investors panic about who owes them money. If you hold a bond, your money is tied to the solvency of the issuer. If you hold cash in a bank, your money is tied to the bank's stability. Gold carries zero counterparty risk. It is an asset held free and clear. If you hold a physical gold coin or a share in a gold-backed ETF, you don't need a third party's promise of repayment. There is no risk of default, and crucially, there is no risk of bank runs or bail-ins, where your assets might be temporarily frozen or taken. This makes gold the definitive asset when trust in institutions evaporates.